What is going on, everybody? The drought is over. Lil Wayne dropped one of my favorite mixtapes of all time in 2008 called The Drought is Over. And I really think the IPO gods are trying to kill me here because we've had 3 Fridays in a row where we were gifted with a fresh S1 to break down. So this is like Christmas came early. 100 verses on mixtapes everywhere, all at once, chaotic, glorious, certified run here. That's what Lil Wayne had, and I think we're experiencing that right now with this IPO run. But before we get into the latest and greatest on StubHub, no, this is not a commercial for StubHub, but this is an ad read for Gelt. And you already know that tax season isn't just a deadline, it's a lever. At Gelt, they work with CFOs who aren't just looking to stay compliant, they're looking to unlock strategic value from their tax position. Think optimize entity structures, real time visibility across complex ownership, and proactive tax planning that actually moves the needle on cash flow. And here's the thing, the tax landscape, it's changing fast, especially for high growth businesses, alternative investors, and companies navigating multi entity complexity. Whether it's preparing for a capital event, evaluating compensation structures, or just avoiding costly surprises, your tax strategy should be as agile as the rest of your business. They give you quarterly strategy check ins and proactive estimates designed to lower your effective tax rate, protect equity value, and drive long term efficiency, all delivered through clear communication with your Gelt CPA in a powerful, modern platform. Learn if you qualify at joingelt.com and schedule a call to learn more. That's joingelt.com. Now, let's talk about the IPO of the hour. StubHub. Dun 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 dun. I like to go to a lot of live events. I don't know if you knew that about me. I also went to the NSYNC No Strings Attached tour with my mother in 2001, I believe that was. That was exciting. Thanks for taking me, Mom. I don't think we used StubHub at the time, but alas. All right, so a couple of metrics on this company. Gross transaction volume. So that's the same thing as like GMV. It's basically the big number that moves through the system. 8.68 billion in 2024. That was 27% year-over-year top line growth. Revenue 1.77 billion. That's 29% year-over-year growth. So 2% higher actually than their GTV. Their take rate was 20.4%, up slightly year-over-year. Gross margin 69% on a GAAP basis, 81% on an adjusted basis. Adjusted EBITDA 299 million. They couldn't have got the one extra million there. 17% margin, and it actually declined 16% year over year. And free cash flow 255 million. That's pretty nice. 14% margin, and that also declined 16 year over year. So StubHub's 20% take rate isn't just a grab for margin. What they're doing is they're bundling buyer and seller fees, payment processing, and fulfillment. And with that high mark, it makes it one of the most premium priced consumer marketplaces, and it does wear that badge of pride, right? They don't shy away from it. And I don't think this is a post-COVID sugar high either. StubHub is showing scaled, sustainable growth, and their revenue is growing faster than GTV. Like I said, 29 versus 27, and free cash flow is tracking close to EBITDA, which you always like to see. That always sucks, like when a company has like massive adjusted EBITDA and then like the free cash flow. It's like that gif of like the pan with something in it, and it's like a full pan for revenue. It's half a pan full of food for adjusted EBITDA, and then like the free cash flow, it's like one leaf on it. It's like, no, there's actually something to eat here. And any margin compression is from reinvestment, not operational rot. I was digging into the numbers. And importantly, this is a marketplace with real unit economics. So, unlike others that are still dependent on VC subsidies to bait users with discounts, StubHub's value prop, it's not cheap tickets. It's a curated, reliable experience for limited supply events. Nobody says I'm getting the best deal ever on StubHub, right? You're not bargain bin hunting here like you would for a ride share or food delivery. You're securing access and you're willing to pay for it. A couple other call outs here. Transactions per buyer last year, 1.6 per person. Average order value, $250, and active buyers, 30 million. That's a big number. And they're not just converting intent, they're monetizing repeat behavior. So the flywheel's spinning and the users keep coming back to that. So I want to talk about their business model. It's a classic two-sided marketplace, right? Sellers list tickets, buyers search, click, and purchase. This isn't like a cybersecurity company where I couldn't actually tell my mom what they do. Like, this is a pretty straightforward business model, right? They're the middleman, and they charge both sides a fee without ever holding inventory. Beautiful. No inventory. Not a bad place to be. And so in the S1, they say we generate revenue by charging fees to both buyers and sellers, a model we believe aligns incentives and reinforces the integrity of our platform. So the buyer fees are in the 10 to 15 range. The seller fees are in the 5 to 10% range. And that gets you to that blended take rate that I quoted before of 20.4%. And it's really a scalable model, right? No inventory risk, low capex, high margin. It's not like they have to own the stadiums either that these events are going on in. And as more buyers show up, more sellers follow, which is nice. What they say here, we believe our marketplace benefits from strong network effects, where increased inventory attracts more buyers and more buyers attracts additional inventory. So that's that proverbial flywheel I was talking about. So marketplace mechanics, search and discovery. Buyers can filter by seat, row, section, and event. StubHub's algorithm services listings optimized for conversion, not just price. Okay. So they're trying to optimize for conversion. And they have pricing leverage, even though they're not setting the prices, but it thrives in the moments of scarcity. So big events lead to higher demand, which lead to higher average ticket size and more fee dollars. On the fulfillment and trust side, they manage ticket delivery, they guarantee the purchase, and they handle support. So operationally complex, but essentially, you need that for trust, right? For people to purchase. Why does this work? Brand trust, like I said, so still the default resale platform in the US. Liquidity, 30 million plus active buyers, which tells you that sellers can move inventory pretty fast if that many people are coming to the platform. And global reach, active in over 100 countries with meaningful cross-border capabilities. So I wouldn't say like StubHub is like just simply Craigslist for concerts. It's a full stack platform with discovery, fulfillment, and monetization built in, and that's how it supports premium fees and strong margins. They say our brand is synonymous with trust, transparency, and reliability in the ticketing industry. Let's talk about how they distribute the product. So their go-to-market is built on brand, buyer urgency, and SEO muscle. Keep that one in mind. Their growth engine is not outbound sales. It's not this expensive field sales motion. It's intent capture. The company wins by being the default destination when someone types, quote, Taylor Swift tickets into Google. And so their growth channels are SEO, so high intent evergreen keywords. That leads to free demand. Paid marketing, mostly Google and retargeting. So that's high ROI per click. And then partnerships with teams of artists and venues. The inventory access there leads to trust. And they don't need to sell tickets. It just needs to be there when the buyer's ready, right? Like it's not this push. It's more like this pull when the event happens. And so when you break down their market opportunity, it truly is a recurring spend category with secular tailwinds. So no, it's not a subscription business, but I mean, events just keep happening and these artists go on tours every year. And so they say, we believe consumers are increasingly prioritizing experiences over physical goods. And this secular shift supports our business model focused on live events. The live events TAM in 2027 is estimated to be 78 billion. And the North America secondary market in 2024 was 18 billion. There are other markets within that. So you got the international resale opportunity of 23 billion and they identified their SAM as 194 billion. So these are some pretty big numbers. And then they get to the TAM, which nobody really pays attention to TAM because it's always just this astronomical number, but 726 billion for the sake of completeness. All right, so tailwinds, experiences over stuff, right? Younger people like going to stuff. Dynamic pricing arbitrage. So they help the market reprice undervalued primary inventory, and then they take a fee on that spread. And then global fandom. StubHub's cross-border capabilities let it monetize, Messi in Miami for a soccer game, but also K-pop in Korea. So it's a massive category that's becoming more digital, global, and monetizable. And they're built for that shift, right? They're digital. And so when we look at their financial profile, it's a high margin marketplace throwing off cash. I haven't seen a business spitting out cash like this come in the IPO market in quite a bit of time, right? We're used to these heavy cash burning companies. And this is not a growth at all cost story. It's a mature asset light business with real margins and real cash flow, right? My friend used to say, my dog can't live on revenue. He needs real free cash flow to live. He needs to eat real dollars. So revenue 1.77 billion, gross profit adjusted 1.43 billion or 81%, adjusted EBITDA just under 300, free cash flow just over 250, cash on the balance sheet at time of IPO 762 million, net debt 738 million. So leverage 2.1x debt to EBITDA. All right, so if you look at the trend of their profitability, despite some modest EBITDA compression, StubHub scaled revenue while remaining profitable, which is a sign that the unit economics are working. Okay. So even though it went down a bit, like they reinvested in their business. And so what I thought would be the most telling comparison here is if you look at the take rate across different marketplaces that are public. So StubHub, 20.4%, Airbnb came out to 14%, Etsy, 18%, Eventbrite, only 8.5%. And then the private data I was able to find put SeatGeek, their closest competitor, at 17.5%. So they're about 3% higher than SeatGeek. And their adjusted EBITDA margin is really strong. It's a bit higher than Eventbrite. It's higher than SeatGeek, but it is lower than Airbnb and Etsy. Airbnb, crazy, 32% EBITDA margin. That's a lot of cash. Shout out to Airbnb, but not those cleaning fees. So StubHub doesn't have Etsy's vertical or Airbnb's brand halo, but it does hold its own on margins and beats peers like Eventbrite, like I said, on scale and monetization. Okay, so 12 key themes that I identified going into this IPO. So the first one is the recurring transaction flow at scale. So they process tens of millions of high intent transactions every year. High intent, I love that keyword. This isn't episodic revenue, it's habitual behavior built on emotional urgency, right? Like you're more willing to pay if Pitbull's in town, Mr. Worldwide, than you are if it's just, some run of the mill, shirt on Etsy. So take rate durability reflects platform control. It's the next one here. So fees on both sides, fulfillment included, and buyers keep paying. That's pricing power plus brand trust, a powerful equation. And despite being the middleman, they really control the transaction. The next one here, they're a rule of 43 company, 14% free cash flow margin. And that puts them in rare air for consumer marketplaces, right? And then you pair that with the 29% revenue growth. Tangent, if you're like one of the psychos who uses EBITDA as the bottom line metric in the Rule of 40 instead of free cash flow, I think you're crazy. But it would be even higher if you were to use the adjusted EBITDA margin. StubHub is in the process of repositioning towards primary and international expansion. So they're going upstream to own ticket issuance, which is interesting. This could be risky, but could unlock new margin layers. And I look at StubHub as a yield optimizer, not a price setter. So, like an exchange, it routes demand to maximize velocity and take without inventory risk. And for them, conversion is the metric that matters most. With perishable inventory, like you can't go to Taylor Swift tomorrow, the velocity matters more than visits. So, they win on sell through. Pricing power embedded in the emotional purchase. So identity, nostalgia, status, buying a ticket isn't rational. It's personal, like I said. And event discovery as a lead gen loop. So StubHub isn't just a checkout, it's discovery, right? You can go there to search for stuff too. That's top of the funnel power that matters. And they say StubHub is not just a transaction platform, it's a discovery engine for live events. That's a really good clip. Discovery engine for live events. And they have this really valuable compounding first party data across different cohorts. So they know who you are, what you like, and when you buy. And they use that. Their user graph is extremely valuable and it leads to compounding knowledge at the point of purchase. So if we look at the operational leverage and support, not just infrastructure, fraud, fulfillment, and CS, those scale better than you think. And they're using some AI to improve that. And their SG&A, so their sales and marketing and all the finance people in the back office, that will flatten with volume. So they have leverage built in there. And they have this strategic optionality with payment flows. Payments is interesting in this business. So there is upside in seller payouts, buyer financing, and then cross-border currency plays. And monetization layers are latent. Everyone wants to be a fintech these days, and StubHub actually could do it if they wanted to. And the last theme here, defensible against disintermediation for now. So teams may want to go direct, but they can't match buyer liquidity yet. So Taylor Swift may want to go direct, but people resell them. I don't know what you're going to do there. Some potential red flags. All right, 3 of them for you. Founder control via dual class shares. So Eric Baker, he holds super voting class B shares. So basically, he can make all the decisions. I believe it's a 10-1, maybe be a 20-1. It's really high. But institutional investors may squirm. Related party dealings with Andro Capital. StubHub paid Baker's other company, Andro Capital, $1.6 million in 2023 for ticket inventory. This was disclosed, but I mean, that's kind of a weird optic. And then historical put right liability. So StubHub let employees sell back equity pre-IPO, and the structure created complexity and temporary balance sheet noise. But it's just like a messy, relic of the past. Let's talk about some valuation scenarios here. So let's say they're targeting somewhere between an 8 billion and 10 billion enterprise value. If you assume that they grow 25% next year, right? So that would be a decrease of about 4 or 5% from the 29% they're at now. That would imply 2.2 billion in revenue and a 3.5x to 4.5x next 12 months revenue multiple. So that's, in my mind, pretty reasonable given their revenue growth and profitability. And those multiples, 3.5 to 4.5x, because I track the multiples every week on mostlymetrics.com by sector and by business model, that would put StubHub above Uber and Car Gurus, but below the multiples for DoorDash, Airbnb, and Zillow, which are the top three. What's the bull case? Their GTV hits 10 billion plus in 2025. International expands and optionality gets credit. Bear case would be market views categories discretionary and the multiples compress. And StubHub, I'm not going to lie to you, it's not a high growth SaaS play, but it could earn premium marketplace comps if the street buys the margin story. So Zillow is trading at 6.3x forward revenue. Airbnb is trading at 5.9 forward. DoorDash 5.7 forward revenue. CarGurus 3.2. Uber 3.2. So can StubHub get over the 3.5x hurdle there? So TLDR, StubHub's IPO, it's really a bet on experience that's driven by liquidity. So StubHub is what happens when a platform captures both demand and emotion. It doesn't create events. It monetizes access to the events. They're not putting on the events. They're giving you access. They're the gatekeeper. And it's been doing that at scale across categories for over 20 years. People forget that this is not an overnight story, right? They were acquired by eBay, then they were sold to Viagogo, and now they're IPOing. So the question isn't whether it's a good business. It is. We know it's a good business. The question is whether investors believe that brand plus trust plus conversion equals durable cash flows in a fee-sensitive world. This IPO, it's not going to trade on hype. It'll trade on execution. And the biggest questions are, can StubHub grow beyond secondary into primary ticketing? Will international markets follow the same liquidity curve? And can it maintain platform trust as it scales? So in short, StubHub has a lot going for it, but to earn a growth multiple, it'll need to prove it's more than just a place people go after a show sells out. It needs to become the default layer for live event commerce, period. Woo! All right. None of this is investment advice. I edited this while watching Ms. Rachel with my 1-year-old. But that's the breakdown on StubHub. Hope you enjoyed it. Please give this podcast 5 stars. Share it with one friend. Share it with your favorite aunt. I don't care. But thanks, everyone. Peace.